So explain the velocity of what they're doing, because obviously they're outpacing some venture firms here in the Valley, and those are venture firms that have massive infrastructure in this space. They don't have that same infrastructure, do they?
They don't. And it's funny. So I pulled for this, I pulled some data from Crunchbase. And this was pretty funny. So through April 20th, just this month, Tiger has been the lead or co-lead on investment rounds totaling $2.5 billion.
Wait, you're saying in the first 4 months of the year?
No, the first 20 days of this month. The first 20 days of this month. And of course, they didn't do all of these rounds, but even if they just did 30% of that 2.5 billion, that's $750 million announced this month with 10 days to go left in the month. That's an entire, medium-sized growth fund at this point. So you're right that the pace and the velocity is completely unprecedented. And I think the best way to explain it, I actually loved what Brad said on the All In Pod, your last episode when you brought him on.
Brad Gerstner from Altimeter.
Yes, Brad Gerstner from Altimeter. And he said something like, I believe if you own an index fund of the top 30% of technology companies over the next 10 years, you'll be incredibly well rewarded. And so that kind of goes to what I think Tiger's ultimately doing. And I didn't touch on this that much in the essay itself, but ultimately they're on a micro basis, yes, they might overpay here for a deal, or they might, invest in one deal that ends up being a fraud, or a couple deals that end up being fraud. But if they're able to invest in basically the broad asset class and get a well-diversified, basically create an index fund of the Series B kind of pre-IPO asset class, I think that is a product that is very attractive to LPs. And like if you came to somebody and said, hey, if you could invest in an index fund of this type of asset, would you do it? A lot of folks would say absolutely yes. But the only way that you can do that is by adopting a strategy and adopting a way of investing where you are investing at, you're turning the dial to 11, and you're not doing as much diligence, you're not joining boards. You have basically this product to founders that allows you to come in, be like, okay, I like this founder, I'm going to write him a term sheet today, which is what they've developed.
Well, and it's not unprecedented. We obviously had WeWork do this. Before that, we had Yuri Milner do it. We've had this tradition in Silicon Valley when things are super hot, people zip in and just say, I'm going to overpay. What was the last round of Twitter? What was the last round of Facebook? I'll come over the top. I'll pay more. It does not matter. I'll look like a sucker today, and I'll look like I'm overpaying today, but in the future, I might not. So thinking out loud here, the ramification for our industry is that zone before the IPO, but after, let's say, product market fit and getting to 25 million in revenue, to pick a number, because are they dabbling in companies under 25 million in revenue, you think?
You see it very occasionally, but very rarely are they leading around. They'll participate with somebody, but very, very rarely. Addition will do it more. Addition's been doing some A's and stuff, but Tiger very rarely.
So when you have Tiger sort of taking over this space, and they're not the only ones, obviously Dan Rose, formerly of Facebook, and Amazon, the only person I know who worked for both Bezos and Zuckerberg, both in their formative years.
And he'll let you know.
He'll let you know that. And he was a great guest on the podcast where he explained it all. Great guy.
Yeah, love you, Dan. Sorry.
Love you, Dan. Sorry. I didn't throw the elbow there. That was a young gun here throwing elbows off the bench. But what is interesting there is that area then becomes, let's say, non-differentiated capital. It's just, as I would tell founders 10 years ago, when you get to that time, it's like you look at the term sheets, whoever gave you the best deal, highest valuation, lowest, rights and change in anything to do with the company's charter and, how it's run.
Yep.
You kind of just take whatever the best deal is because they're buying 1 to 5 or maybe 10% of the company, and they're typically overpaying for it. So that means the venture game is now going to be 25 million and under. That's the game. Or is this mean that game, 25 million in revenue to when you go public, is the game? If you see what I'm saying.
I do. And I think both are correct. I think the game has completely changed, and now there's a separate game on the post kind of like Series B or post product market fit, post 25 million. And now there's a new game at the early stage. I think the early stage still resembles a lot of kind of what we thought of as like this traditional venture asset class, where you build really strong relationships, you join the board, et cetera, et cetera. Whereas the growth market now, it's funny. It's like the hilarious truth is that one of the best investment strategies in venture growth, the Series B and beyond over the last 5 years, is looking at a SaaS company, just meeting every SaaS company you can, and finding the one that is growing the fastest and paying whatever the market clearing price is. Yeah. Some of the best SaaS investors I know can barely do algebra. Like they are not quants. They're not, digging into spreadsheets, but they can connect the dots on a net new ARR chart, and they know how to do like net dollar retention and logo retention. Those three things are all that have mattered for the last 5 years. And so it is this entirely new game at the growth-ish stage that is defined, I think, by scale and by the ability to move very quickly. And that is why you've seen Coatue kick a lot of ass in the last 3 years, why you've seen Tiger kick a lot of ass in the last 3 years, because they're built for it. Like their firms literally have been doing high velocity, high scale investing for decades in the public markets. And they are much more kind of able to bring that down into private markets and play this sort of game than folks that, really look like venture firms, but have been dabbling in growth just because it's an easy way to make returns and kind of bolt on. So I do think it's a different game on both sides, but I also think that there's plenty of situations and plenty of founders that are still not going to go with the Tiger crossover type product at any round. And we can go into that as well, but I'll stop there.